Let's take a closer look at that crash, since it might be a useful framing for understanding the next one. First and foremost, it was a pileup of crashes. There was the Internet 1.0 crash from March 2000, October '02, and the 9/11/2001 terrorist attack related crash, and the Enron scandal and crash from October to December of '01, and the WorldCom crash of July 2002, which was part of the overall telecom crash, which started in 2001. The broader S&P 500 collapsed by 49% in that same period. But even with that, was still above the record levels of the late 90s, which speaks to how far ahead of itself the market had gotten. With the overall stock market crash, both short-term and long-term interest rates collapsed from 6.5% to 1.75%, and from 8.5% to 6.5% for short-term and long-term rates, respectively. And that helped significantly in the market recovery. But the key thing to note is that GDP itself, which is to say spending and income, held up fairly well, reminding us that the stock market is not the economy. Let me repeat that. The stock market is not the economy, and we have to look past the stock market to deeper economic fundamentals, such as real estate, which we've often said is the largest sector in the economy, to make an assessment of GDP trends. You will note that in this crash, nominal GDP never declined. Economists have concluded that there was a real GDP recession in '01, but we would note that real GDP, meaning nominal GDP adjusted for inflation, did not decline for 2 consecutive quarters, which is the broadly accepted definition of recession. More importantly, real GDP measured against the same quarter in the previous year never declined and was always positive. Unemployment, which had been in the 4 to 4.5% range, generally did not exceed the 5 to 6% range in this period and never exceeded 6.3%. So a calamitous stock market in 2000 through 2002 was accompanied by a mild and short-lived recession.